Financial securities are like fancy pieces of paper or digital records that represent some kind of value or ownership. They're used to invest money and earn returns. So you buy them and pay money, and you wait and get profit from this transaction. You, as a future financial advisor or financial planner or investment advisor, you will definitely need to deeply know different types of financial instruments, or the other name is financial securities. Why? Because you are going to invest your client's money in one of these types of securities. How could you do it without knowing the different types? In this lecture, we're going to dive into different types of financial securities. Let's get to it. All right, let's get to it. There are four different types of financial securities: fixed income, or the other name is debt securities, equity securities, investment funds, and the others. So this others include every other securities that are not categorized in the first three types. Let's get to fixed income securities. They're called fixed income securities because they give you a steady, predictable income over time. It's like getting regular paychecks from your investment. Here's how it works. When you buy a fixed income security from a company or government, you're lending money to a company or government. In return, they promise to pay you fixed interest payment, like let's say 6% annually, on a regular schedule for a certain time. That's why this is fixed income. We have three types of fixed income securities, which are bonds, debentures, and money market securities. If I want to explain the difference of these three in simple terms, let's say you buy a bond from a company, and the company promises you that it'll give you 6% annually. If the company, for any reason, can't hold the promise and can't pay you, the company's assets like buildings, machinery, and etc. can be sold to repay you. In other terms, bonds are secured by a physical asset of that bond issuer. Debentures, on the other hand, is not secured and backed with the physical assets. You just have to trust the issuer's reputation and promise. Mostly provincial governments issue debentures, not companies, because people can trust governments, but it is hard to trust just companies. Let's get to money market securities. Money market securities are those which have less than 1 year term. If a company or government has a short term goal that they want to address, short term, I mean less than 1 year, they issue money market securities, and individuals like me and you purchase that security and make small profit. Money market securities are categorized into T-bills, commercial paper, and bankers' acceptance. Please keep this in mind that this is just an overview, and we will talk about each of these securities in future lectures and chapters. I just wanted to give you a bird view of this categorization. Let's get to equity securities. Equity securities are basically shares of a company that you can buy. When you own equity security, you're buying a small part of that company. There are two types of equity securities, which are common shares and preferred shares. The main difference between preferred shares and common shares is how you earn money and what happens if the company gets into trouble. If you buy a common share of a company, you earn money if the stock price of that company goes up. But if you buy a preferred share of a company, you earn money through receiving dividends from that company. Now, if the company get broke, preferred shareholders have priority on assets. Again, we will dive deeper in the future into these different terms. The third type of financial instruments are investment funds. Investment funds are like a big pool of money that many people put their money into it. This money is then managed by professionals who use it to buy things like stocks, bonds, or other investments to try to grow it. Here's how it works. Instead of one person investing a lot of money on their own, many people contribute to the fund. Then the fund manager decide how to invest that pool of money in different types of securities. There are two main types of investment funds: closed-end funds and open-end funds, or the other name is mutual funds. The main difference between open-end funds and closed-end funds is how they are bought and sold and how their value changes. The number of shares in an open-end fund changes constantly because you can buy or sell shares from the fund at any time. When new investors buy shares, the fund creates new shares for them. When investors sell shares, the fund removes those shares from circulation. This means the total number of shares in open-end funds can go up and down depending on how many people are buying or selling. The number of shares in a closed-end fund is fixed once the fund is created. When the fund is launched, a specific number of shares are issued to the investors, and this number doesn't change. After that, investors buy and sell shares on the stock exchange, but the total number of shares in the fund stays the same. The price of these shares changes based on market demand, but the number of shares doesn't increase or decrease. Open-end funds or mutual funds can be categorized into different types of mutual funds, like 7 or 8 types. But here we just listed the most popular ones, which are equity mutual funds, fixed income mutual funds, and balanced mutual funds. Let's get to type number 4, others. This include derivatives, ETFs, segregated funds, hedge funds, PPNs, and lots of other different types that we couldn't categorize in the first 3 types. Wow, what a long lecture. Remember, we're gonna dive deep into each of these securities throughout the course, so no worries at all. You're doing a great job. Continue and we will get it done together. I'll see you in the next lecture.